We have a deduction question. Someone wants to know, how can I take advantage of the Section 179 deduction for equipment purchases?
Yeah. So I was talking earlier about the bonus depreciation. So bonus depreciation and Section 179 are somewhat similar. So 179 is the ability to deduct capital equipment, but there's more limitations on 179 than there are on bonus. So let's just say you buy, like a snowplow or something, because it's snowed here today. So let's just say it's a $10,000 machine. The Under bonus depreciation, you would apply whatever the percentage bonus is to that equipment type. So let's say it's 60% bonus. So if you get a $10,000 machine at 60% bonus, it's a $6,000 deduction, just that's it, right? And the remaining 4,000 is going to roll forward and be depreciated over whatever the lifetime of that piece of equipment is. Under 179, you could deduct maybe 10,000, but it depends on a couple things. So one is that it's got to be 179 eligible property. A second thing is that there's a global limit for 179 deductions, which is was like 2 million bucks. So most people don't have to worry about that. That's for like big companies. But the thing that catches people off guard is that 179 is only applicable up to the amount of profits that you have. So if you had $15,000 worth of net profit before factoring in this $10,000 piece of equipment, then you can 179 the full 10,000 and you're left with 5 net profit after that deduction and you're good to go, which would be better than a 60% bonus in that situation. However, if you had a net loss already before the deduction for the equipment, then you can't 179 that at all. So it's just 179. And in that case, it's better to do bonus. In some cases where you're in between, let's say you had $7,000 worth of net profit, you could take 179 on the 7,000, and then you could take bonus on the remaining 3,000. And so then you would get the $7,000 179 deduction would get you to zero. And then 60% of the 3,000 remaining would be 1,800 bucks, would get you to an $1,800 net loss. So in that case, that actually works out the best of all the scenarios. If we go back to a scenario, or if we go back to an environment where we get 100% bonus depreciation, 100% bonus depreciation is always better than 179 because it doesn't have those limits applied to it. But if bonus goes away, and bonus is one of these things that has come in and out of tax law over the years. So sometimes there's no bonus, sometimes there's 50% bonus. We've had this 100% over the last several years, which has been fantastic. It just depends on which method ends up being more advantageous depending on the particular numbers and circumstances of your situation. That's the basic idea. It's got to be eligible property, and you have to have the net profit to absorb it. And those are the two primary things that trip people up when it comes to 179. I saw a Grant Cardone clip of on YouTube of him saying he was talking about, oh, you should buy a G-Wagon.
I remember that.
It's a $150,000 write-off. It's over 6,000 pounds, and blah blah blah. And it's like, yeah, maybe you have to have $150,000 worth of income to have that make sense, and all these other caveats that go along with it. It's a very much it depends. It depends on the numbers, depends on the circumstances, and depends on the not just the numbers of the item itself, but what else is going on in your business as to whether 179 makes sense or not. But again, if we go back to 100% bonus like we have been, then that's always going to work out better, as good or better, because there's no net profit limitation.
So is this kind of sort of, it depends question?
Yeah, it depends. Absolutely.
Understood, understood.